Hello and welcome to a Wealth of Advice market update on the 18th of January 2022. It's the first market update we've done this year. We're now 2 years on almost since COVID came to the world. That's what prompted us to start doing these market updates. As we were getting to the end of 2021, we were starting to feel COVID was getting behind us from the point of view of how it was affecting markets and such like. Markets had done very well during the first 3 quarters of 2021. And then the last few months of 2021, things were a little bit negative. So any clients who've just been with us for a few months now will have seen maybe market valuations, fund valuations go down over the last few months of 2021. Hopefully today's presentation will reassure people that there's lots of things to be positive about this year. Like every January, we always speak to a lot of fund managers about what they think the prospects are for their funds and different asset classes for the coming year. So we're going to look at that. What's the positive things that we can be looking for? Also have a look back at 2021. What was the best performing asset classes? What didn't do so well? And hopefully that might give us a bit of an insight as to what might happen this year. And then also reassure you that we think we've got our portfolios positioned in a sensible kind of way. Overall, during 2021, most markets that we invest clients' funds into performed very well. Mainly with the exception being with bond markets, government bonds, corporate bonds. They were negatively affected due to higher inflation that came through during the year. Then as we got to the end of 2021, the Omicron variant rearing its head spooked investors a little bit, and as I say, we saw markets go down towards the end of the year. But we learned a lot about COVID and the Omicron variant and how that will affect markets going forward. Markets didn't fall off a cliff like they did in 2020. The major market is across in the US. As ever, the Omicron variant, the numbers over there is still affecting things massively. They don't have as high a vaccination rate as what we have in the UK, so that needs to be sort of looked at. But you've got to hope and anticipate that if that Omicron variant isn't as strong the world over and there isn't any new major variants in the coming months, we should see positive returns from markets and positivity return. The Bank of England raised interest rates to 0.25% in December. For any savers out there who have money in the bank, you're not going to see any major difference in the savings rate that you receive. The relevance of them increasing the interest rate was to try and put a curb on inflation. It's the only tool that the Bank of England really has, is to raise interest rates to try and reduce overall spending. But to 0.25% for most general consumers, it's not going to affect you massively. That said, when we talk about inflation, that is affecting consumers massively. People are experiencing high energy costs going through the roof at the moment. That's a definite negative, and it will affect consumer spending as we go throughout the year. That might spook the markets. So we need to keep a close eye on that and see how it affects things. The next area we look at is developed markets versus emerging markets. The first 10 years of this century, emerging markets really surged ahead. That was the place to have your money. China really coming out and growing did very well. Obviously, we had the financial crisis in 2007-8, which affected a lot of the developed markets massively. But then from 2010 onwards, developed markets really came back, and that was the place to have the money. So where we go next, it's hard to call at this stage. China is doing all it can to maintain its growth levels, but we're expecting China's annual growth rate to be lower than what it was previously. They're currently loosening monetary policy to try and stoke growth, and that would help emerging markets. But personally, I believe that the more developed markets will be the ones that come out of COVID and perform the best in the coming couple of years. And again, that's where our portfolios are slated towards. Obviously, a key area that we have to look at is volatility. Volatility measured by the VIX index. We've shown this graph a few times over the last couple of years. As the VIX index rises, it suggests that a market fall might be around the corner because volatility is going really high. However, as you can see there, on news of the Omicron variant coming through in December, the US stock market VIX index rose to almost 30, which was a really high level, but we didn't see a market collapse, so to speak. Again, those clients who have been invested with us for a few months will have seen the values go down, and it hasn't been a positive last couple of months. But it certainly wasn't a market collapse. As the Omicron variant becomes less worrying to markets, you'll see the VIX index, and you have seen the VIX index reduce, and the markets will hopefully rise from there. So we now look at how all the different asset classes that we might invest clients into performed during 2021. As you can see from this graph that we put on the screen now, which I apologise, it is a little bit busy. The S&P 500 is at the top there, up over 29% over the calendar year 2021. FTSE 100 very positive over the year, plus 18.44, and you can see right at the bottom, UK government gilts had a torrid year, minus 5%. Again, that's caused because of the fears over inflation coming in and how that would affect government gilts, as well as the corporate bond that was minus 1.92. Sterling high yield bonds only did 4%. High yield bonds will often perform like stocks and shares might perform because they're the riskier bonds, if you like, but even them only did 4% during 2021. This quilt, as we call it, quilt of performance, you may have seen either on our presentations or in other investment brochures in the past. Every year you will list and rank which asset class performed better than others. 2021 was the year of commodities, REITs, which is property, gold, oil, what you would class as real assets. They outperformed paper assets. Will that happen in 2022? I don't believe that will be the case. I think the US equities, European equities, even UK equities should have another good year and may outperform them. But at this stage, what we will say to clients, we've got a multi-asset portfolio system for all clients invested across a wide range of asset classes. Who knows what 2022's best colours are going to be, but we'll certainly be keeping an eye on all of those for you. Now when we compare the various different stock markets over 2021, again US well and truly at the top, but look at the bottom one there, the Shanghai Stock Index minus 6.68% over the year. As I say, China are doing various things to loosen their economy to make that not be the case next year. Emerging markets minus 1.68 overall last year. Let's see where that goes through 2022. And then we look at stock market performance here over the last 6 months. We mentioned volatility with the VIX index getting really high as we got into December when the Omicron variant was making the headlines. And just look at how those lines are all bouncing up and down there. The only place to make real returns, the best place to make real returns over that period was the FTSE 100, which is encouraging for those clients who have a bias towards the UK market. But overall, everything performed pretty much similar. And as I say, you can see from those clients who were invested just from the end of November into Christmas, you would have lost money over that short period of time. So on that previous graph there, we mentioned that high yield bonds had produced a positive figure of around about 4%. On this graph here, you can see that's the brown line at the top. Virtually every other type of corporate bond or government bond that you could be invested in during 2021 didn't have a good year. Sterling strategic bond was plus 0.77%, but the more cautious stuff, your regular corporate bonds, government gilts, even global government bonds, they all lost money during 2021. Again, just to repeat, that was all caused through the fear of inflation coming back to the markets. This next chart that we put up, a lot of clients like looking at this. It goes back to that awful time back in February 2020 when COVID first came to the world and markets fell off a cliff. And as you can see there, anyone who was invested at that point, your notional £100,000 might have felt to be worth around about £80,000, both risk score 2, risk score 3. Both fell in the same direction, whether you were a bit more cautious, a bit more adventurous. It didn't make any difference at that time. There was a big sell-off of everything. Markets have then recovered. Those clients who've taken a bit more risk have been rewarded. And to see those returns there, £115,096 from £100,000 on February 2020, we think it's been great returns. There's been a lot of volatility along the way, and that's likely to continue, but we're very pleased with how those portfolios are faring. The final chart that we're going to put up is something which I've just been looking at in the last couple of days. News headlines: might Boris lose his job? How might that affect things? Everything that's going on there. Again, without making it a political debate, it's quite incredible how he still has his job with everything that's been coming out in the press the last few days. But the interesting part of it is how the pound has been performing against the dollar. As we got into December, the pound fell massively. Again, fears over the Omicron variant. UK was one of the first big countries who was affected by this. There was fears of more lockdowns and such like coming, and as we went through the Christmas period, everyone was wondering, was there more lockdowns going to happen? It didn't happen. The hospitalisations, the death rates didn't really rack up. So we've come out of that, and then you can see the pound strengthening again, and it's now coming back up. And then interestingly, something I read was saying the pound would rise again if they thought there might be a change in Prime Minister in the UK, because that might give more certainty over the future and how markets will look. And it just gives a general feel of what people look at and how the UK economy fares. When you look at the pound against other currencies. So I say, like the VIX index really went up during December because there was a fear over what was going to happen, the pound also fell at that same point. It's correlated, but we're now coming back out of that. So hopefully that means there's positive times ahead. So thanks for listening to another Wealth of Advice market update. Hope you found that useful and informative. Again, as ever, if anyone has any questions or anything they want to need answering, please get in touch. I'm pleased to say that we are going to have an in-person client event at the Ramside again in February. We'll be sending details across that on a separate email. I believe it's Friday, February the 18th that we're doing that. We've invited several fund managers, and we've gotten a few fund managers have agreed to come. I hope as many of you can attend that as possible. Obviously, we would record some snippets from the day and share that with yourselves, but it'd be great if as many of you watching could come as possible. Thanks again. Bye now.